Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's midday, Thursday, January 22nd, and the title of this week's audio blog is The Shadow of Crisis. It's Wednesday afternoon as I start, and likely I'll write part of this week's script today and part tomorrow morning. Frankly, there are just too many horrible headlines to address at once, which is why recent audio blogs have been upwards of 7 pages long. Last week's was fittingly titled, The SNB Starts and Ends the Gold Bear Market, with bear market in quotes, as not a shred of what has occurred since paper silver peaked in May 2011, and gold in September 2011 has been related to free market forces. Instead, it was simply the terminal phase of government can-kicking, starting with the deer in headlights fear they experienced in May 2011 when silver hit $50 per ounce, and culminating with the closed-door meeting between Obama and the too-big-to-fail CEOs in April 2013. Regarding the former, the run to $50 silver was clearly catalyzed by the launch of Eric Sprott's, or as I call him, Admiral Sprott's, closed-end silver fund in October 2010, ticker PSLV. When the $500 million IPO was launched, silver was just $25 an ounce. Just 7 months later, it had doubled to $50, with premiums and delivery times spiking on real physical silver as supply dried up, quite obviously exposing the terrifying fact, to the cartel that is, that so little availability of available for sale silver actually exists. A mere $500 million of buying cleaned the entire market out. This jibes exactly with the conclusions of last year's Miles Franklin All-Star Silver webinar panel, i.e. that no more than 2 billion ounces of investment-grade silver exists above ground, the large majority of which, such as mine, will never be available for sale, at least not at prices in the double or perhaps triple digits. Thus, just as in 2008, when the financial crisis took Wall Street by surprise, the powers that be panicked with an extremely sloppy and transparent response. To wit, the May 1st, 2011 Sunday night paper silver massacre, in the wee hours when China was closed for a holiday, demonstrated a comical lack of planning, using a highly suspect cover of bin Laden being killed as the so-called excuse for silver's decline. The fact that gold had recovered all its losses by noon Monday morning, and silver the majority of its losses, seems to have been forgotten by the historians. No, the real carnage didn't occur until then, when, with no markets materially moving on the amazing bin Laden news, the cartel raided paper PMs like never before. Not to mention that killing a figurehead, terminally ill terrorist a decade after 9/11 should not have the slightest impact on silver prices. Anyhow, when silver rose back to $42 an ounce in September 2011 and dollar price gold hit an all-time high of $19.20 per ounce, the powers that be realized they had no choice but to go all in with relentless PM suppression, along with equally relentless stock support, interest rate management, and exchange rate manipulation. Starting with September 6, 2011's Operation PM Annihilation 1, on Labor Day night in the States, when the Swiss National Bank made it the most PM bullish announcement ever, i.e. pegging the franc to the euro. The level of PM suppression has been since off the charts, particularly when realizing that the reasons PM soared in 2011 are not just more so today, but dramatically so. That said, prices still roared back, no matter what the cartel threw at them, and thus, by April 2013, with gold hanging tough at $1,600 an ounce and silver $32 an ounce, the powers that be realized it was time to take things to DEFCON 1. After all, PM demand was as strong as ever, and with the global economy continuing to weaken, it was not an option to simply allow PMs to rise and then smash them down violently, as they did in the Operation PM Annihilation 1, Operation PM Annihilation 2, and leap day violation attacks discussed in last week's audio blog. After all, the U.S. had just commenced QE3, Japan had just launched Abenomics, and despite legal wrangling within the Eurozone, it couldn't be clearer the ECB too was destined for a massive QE program, which, by the way, finally got launched today. And heck, they hadn't even factored into the equation that China's historic real estate and construction bubble would burst. causing the PBOC to step up its own ludicrous speed money printing, for those that have seen Spaceballs. Consequently, the aforementioned closed-door meeting between Obama and the too-big-to-fail CEOs, which Goldman Sachs front-ran by putting out an aggressive short sell on gold the day earlier. At that meeting, the Fed's so-called tapering scheme was launched, in which nonstop propaganda of U.S. recovery would be supported by manipulated markets and economic data, to the point that as I write today, neither have even the slightest semblance of reality. To that end, they probably actually convinced themselves that by trashing gold, preventing the Dow Jones propaganda average from ever falling, and managing interest rates and currencies on a minute-to-minute basis, they could actually create a self-perpetuating recovery. Each step was planned, from the initial tapering rumors to the comical manipulation of GDP and employment data, diffusion indices, consumer confidence surveys, and anything else that would support their hope of eventually normalizing interest rates, reducing the Fed's balance sheet, and enabling the economy to, quote, grow out of its gargantuan debts. And of course, smashing PMs relentlessly, particularly during key attack events like FOMC meetings, and heck, the minutes of such meetings, despite publication an entire month later. However, the initial plan backfired so badly, the Fed has been forced to significantly step up the manipulations, compounding the financial and economic deformations, and making an already unstable situation far more so. Sort of like the movie Fargo, wherein the initial ransom plan was botched so badly that by the end of the movie, everyone was either dead or jailed. The very next day, that is after the April 12th, 2013 meeting, the alternative currencies destruction was launched, like the prior year's Leap Day violation raid, coinciding with the commencement of Ben Bernanke's meaningless semi-annual Humphrey Hawkins congressional testimony. Since then, cartel suppression has taken my age-old manipulation mantra of each day worse than the last to a new level, culminating in November 2014's pre-Swiss referendum raids and the days surrounding December 2014's FOMC meeting. In the former case, to prevent a run on the world's remaining gold, and the latter to prevent universal realization that the aforementioned April 2013 scheme had failed, i.e. the Yellen reversal I have long called for. In both cases, they succeeded in temporarily suppressing PM prices and raising the Dow. However, in the process, they created massive collateral damage, like crashing currencies the world round. Moreover, the historic crude oil and commodity crash again took them by surprise, making it still harder to maintain the veneer of control. To the point that this week's Fed-dictated John Hilsenrath article in the Wall Street Journal, claiming the Fed remains, quote, on track to raise rates, quote, later this year, was literally laughed at by the investment community. And when the Swiss National Bank took the incredible step, albeit one I had loudly predicted, of depegging the franc from the euro, even the MSM started to question the central bank's cumulative credibility. To wit, as I wrote in Tuesday's urgent cry to Europeans, 3 of the world's biggest propaganda cheerleaders published virulent, scathing attacks on the establishment Monday alone, starting with the New York Times, home of establishment lackey Paul Krugman, publishing Swiss give a scary lesson on the limits of central banks, whilst Bloomberg claimed not even Mario Draghi can save Europe now, and even CNBC asked, is QE enough to save the Eurozone? And today, following not only the ECB leaking of details of the 1.1 trillion euro QE program it will announce tomorrow, comprised of $50 billion a month for the next 21 months, but a surprise rate cut by the Canadian Central Bank and 2 of the Bank of England's most hawkish governors saying they no longer support rate cuts, MarketWatch joined the ranks of skeptical MSM outlets in stating, as central banks surprise, the Fed may have to throw in the towel, in which they predict the Fed will have to abandon the aforementioned plan to raise rates later this year. I mean, duh! What part of commodities crashing to 2008's lows and the U.S. 30-year Treasury yield hitting a new all-time low today do people not understand? Does anyone really believe the Fed could raise rates in such an environment? I mean, think about it. Just last month, the FOMC consensus was that the Fed funds rate will be 2.5% by the end of 2016. For those that don't understand this term, Fed funds are the ultimate short-term rate, representing overnight lending. And thus, to think rates for overnight money will be 2.5% next year, when the 30-year Treasury yield fell to 2.35% today, is pure idiocy. Again, the Fed, nor any major Western bank, will never raise rates again, at least not until the inevitable hyperinflation they cause, which will render the concept of interest rates moot. To that end, the chinks in the central bank's armor were gaping before the SNB decision, as way back on October 7th, before the historic crude commodity and currency crash commenced, I wrote that 2008 is back. And now, with the global economy in utter freefall mode and the SNB announcement permanently destroying central bank credibility, not only is the entire world starting to realize rates can only go down, as the race to front-run QE to infinity has become the only game in town. The fact that the inevitable result will be hyperinflation isn't even considered. As per what I have discussed for the past year, money managers, be they individual, institutional, municipal, or sovereign, are paid to do what everyone else does, as taking career risk in the hopes of a bit of extra alpha isn't even an option. Plus, so many have been hopelessly indoctrinated by Keynesianism, they will never see that it doesn't work, particularly if their livelihood depends on it in a warped financial version of the Stockholm Syndrome. Of course, if they did even a modicum of research, they'd realize that not only have the prior 599 fiat currency regimes failed, but the current one is, by all objective data, in its terminal stage. On the eve of the ECB's long-awaited QE bonanza, which somehow managed to get done despite massive German resistance, I'm looking at a chart depicting the explosive increase in the Fed's balance sheet since QE3 was unleashed, of roughly 100%, and superimposed on it the utter freefall in both global GDP estimates and U.S. inflation expectations. In other words, it, as well as QE1, QE2, Operation Twist, QE3, and nigh 7 years of zero interest rates, has not only failed, but done so dramatically. And over that time, the U.S. labor participation rate has plunged to a 38-year low, and that before the oil price crash. Real wages have continued to free fall as well. Entitlement spending has exploded to the point that more than half of Americans are dependent on the government. And oh yeah, the national debt has risen by $8 trillion. Not including, of course, the parabolic growth of off-balance sheet debt by Fannie Mae and Freddie Mac, upwards of $6 trillion, care of the modern version of subprime lending. Yes, central bank credibility was forever destroyed by last week's Big Bang announcement by the Swiss National Bank. Although again, I can't emphasize enough how ridiculous it is that people were so taken by surprise, despite Thomas Jordan vehemently supporting the peg just days earlier. I mean, for the past 2 months, I've been demonstrating how the Swiss National Bank's balance sheet has been blown up so monstrously by the peg that in just 3 years it has become far larger as a percentage of national GDP than either the Fed or the Bank of Japan. Putting in perspective, the size of the SNB's balance sheet relative to that of the Swiss economy has become as disproportionate as the supposed Belgian U.S. Treasury purchases, amounting to 80% of Belgian GDP. Of course, in the case of Belgium, it was but a ruse, as the real buyer was the Federal Reserve, while in the Swiss case, it was actually the Swiss bank, using taxpayer, i.e. printing press, funds. Of course, the SNB is hardly the only central bank to have entirely lost credibility. Cumulatively, not a single one has been right in either its economic forecasts or the expected results of their various NERP and QE schemes. However, what really draws investors' attention is the lies, such as when China's PBOC in early 2014 claimed it was on the road to tightening policy, only to turn 180 degrees by August, initiating a massive campaign of rate cuts, relaxed lending regulations, reserve requirement reductions, and even a minor devaluation of the yuan. In Japan, Abenomics was not only expanded in October, but accompanied by the world's largest overt central bank stock buying program, which, by the way, purchased more stocks last week than at any time in Japanese history. Shinzo Abe promised inflation, and sadly, citizens have gotten it full bore, while economic and activity simultaneously collapsed and real wages fell to multi-decade lows. You know, like the chart above comparing the Fed's balance sheet to GDP expectations. In fact, following yesterday's Bank of Japan meeting, it dramatically reduced its forward inflation expectation from 1.7% to 1.0%, In other words, despite the massive increase in money printing, things are getting far worse in rapid fashion. But don't worry, Bank of Japan Governor Haruhiko Kuroda claimed he is more optimistic about 2015. I mean, seriously, you just can't make this stuff up. In England, which in true U.S. hanger-on fashion has been using its printing press and derivatives expertise in an attempt to manipulate perception that a rate increase was forthcoming sometime in the future. But it turned tail itself yesterday when the two biggest hawks on its governing board said they no longer support rate hikes. I mean, can you imagine if that happened in the States? If you had, I think, Placer or whatever these guys' names are, said, we're no longer hawks, now we're doves? And how about the Bank of Canada, which not surprisingly, given its massive oil industry exposure, unexpectedly cut rates yesterday, prompting one of the biggest one-day plunges in the loonie on record. I'll get back to the global gold bull market in a second, but suffice to say, now that the Canadian dollar has plunged to essentially a 10-year low, Canadian dollar price gold is now just 11% below its all-time high, joining a litany of global currencies in the same boat, as the dollar index hits a new 11-year high. Not due to anything remotely resembling political or economic strength, but simply, as I've said all along, a global flight to liquidity as soundly based fears that the big one is coming explode. All along, I have said the dollar index is more likely to surge to 150 than plunge to 50, as in my view, there is no conceivable way a global economic shock would destroy America without having long since destroyed Europe, Japan, and most everyone else first. This is the, quote, privilege of holding the world's reserve currency, which, by the way, the world gave to America. We didn't take it, they gave it to us by allowing us to renege on the gold standard. Which, of course, this reserve currency status also serves as a curse, as due to the catastrophic plunge in manufacturing market share and jobs it entails, as well as the more rapid rate of debt accumulation it engenders. But remember, having the reserve currency against other fiat trash isn't worth the paper it's printed on, as Gerald Celente would say, when comparing it to how it has always done, and soon will again, against real money, i.e. gold and silver. But of course, what I just described about the catastrophic impact of the strong dollar, albeit more from a political standpoint than economic, as the increased amount of jobs are offset by higher inflation, is being felt the world round, and particularly now that the worst recession since the 1930s is encircling the globe. And care of what I wrote 2 weeks ago in the direst prediction of all, care of some excellent research by David Stockman, I believe strongly that, until hyperinflation inevitably arrives, the massive industrial overcapacity catalyzed by 15 years of maniacal money printing and financial engineering, deflation will decidedly triumph over any and all central bank schemes. And this in a world with more debt than in prior centuries combined, with currencies collapsing by the week, making such debts exponentially more onerous. To that end, politicians and bankers alike will expand what I deemed the final currency war 2 years ago to epic levels, whether it's the aforementioned Chinese easing, which unquestionably will go parabolic after Tuesday, meaning 2 days ago's GDP report depicted the slowest rate of growth in 25 years, or the maniacal expansion of Abenomics, tomorrow's expected 50 billion euro per month ECB QE program, or inevitably the Big Bang to end all Big Bangs, when the Yellen reversal I have predicted for some time yields an otherworldly QE4 program, likely sometime later this year. To that end, I have to give kudos to Peter Schiff and to Brent Johnson of Santiago Capital in pointing out that from a depegging standpoint, the Swiss bank announcement is but a pimple on the arse of global finance. Yes, the aforementioned credibility hit was devastating for the central banking cabal, and yes, the vote of no confidence in the euro damning. However, from an economic perspective, it's essentially immaterial, as from an economic standpoint, Switzerland is itself a pimple on the arse of global trade. No, the real Big Bang to end all Big Bangs will be when the PBOC inevitably depegs the yuan from the dollar, which, contrary to what mainstream thinking pervades, may well cause it to plunge rather than soar, at least in the short term. Why, you ask? For the same reason as noted above, as relates to all currencies in times of crisis. Because the dollar is still the world's reserve currency and thus has significantly higher liquidity. Heck, due to strict PBOC regulations, the yuan isn't even fully convertible, making it far less liquid. And oh yeah, it is suffering under the collapse of history's largest real estate and construction bubble, with 1.5 billion people to feed and an inept communist government. Sure, they have more gold than anyone else, but that won't matter until after the financial and economic Armageddon passes and a new monetary system emerges in which not only will the world embrace only real money, but will be well aware of how much each government owns. Not what they tell us they own, mind you, but what is proven out through third-party audits. Frankly, it's hard to believe the yuan dollar peg can last much longer. As per what I wrote above, the final currency war has now gone nuclear. To wit, with China's economy in all-out freefall, the last thing its hopelessly Keynesian government, which as mentioned above has the responsibility of 1.5 billion hungry communist mouths to feed, is a strong currency. Thus, the dollar's explosion has caused the Chinese yuan too, by default, to explode, yielding significant market share declines relative to other non-dollar peg nations, particularly in Southeast Asia, most importantly Japan, which not only is by far its biggest manufacturing competitor, but has become a borderline geopolitical enemy as well. To that end, the yuan, because of the dollar surge, is now up 30% against the yen in the last year or so. In my view, the dollar strength we have seen is just jacks for starters, as Bill Murphy would put it, as without question we are headed for the depths of global economic hell in 2015. And when it arrives, if it hasn't already, the only assets that will be desired are highly liquid, government-supported ones. And of course, no asset is more liquid or backed up by a bigger printing press than the US dollar. Of course, the dollar is intrinsically worthless and becoming more voluminous with each passing day, whilst gold and silver are intrinsically priceless, becoming more scant each day. To that end, for mining share aficionados, which as you know I am clearly not, take a look at what El Dorado Gold reported yesterday. Yes, EGO, large enough to be included in the Huey Index, plunged 20% yesterday, and I think it's now down 80% or so, when it reported its expectation that 2015 gold production would plunge by 10 to 20%, whilst its all-in sustaining cost rises by 23 to 28%. This, my friends, is representative of what the global PM mining industry is headed for, and far more so silver, as not only is it further below its cost of production than gold, but given its heavy reliance on base metal mines for byproduct production, could see catastrophic supply declines as heavily economically sensitive metals like lead, zinc, and copper collapse. This was one of my predictions at the beginning of this year, and of the Miles Franklin Silver All-Star webinar panel, which believes that it is entirely possible that a 25 to 50% plunge in silver production over the next 3 to 5 years is possible. Anyhow, tomorrow morning is the official ECB announcement, although they already leaked the amount to be 50 billion euros per month through the end of 2016. The euro sits just above the 11-year low of 1.148 achieved 2 days ago, closing at 1.162. And European sovereign bond yields are sitting near record lows, even with Sunday's potentially cataclysmic Greek election forthcoming. Here in the States, people are not yet focusing on next Wednesday's potentially momentous FOMC meeting, as with each passing day, the odds of said Yellen reversal occurring increase dramatically. I mean, think about it. The last 3 Dow Jones propaganda average rallies were entirely due to Fed intervention, and of course the PPT, both verbally and market-wise, starting with the Bullard bounce on October 17th, went to a rescue a plunging market ahead of the October 27th meeting when they were going to announce the end of QE. He said the Fed lied and said the Fed should continue with QE. Then, surrounding the December 17th FOMC meeting, the Fed goosed the Dow by more than 1,000 points, despite the Fed not only saying nothing incremental, but actually leaving the considerable time language in its statement. And LOL, saying, don't worry, the oil price decline is transitory. However, that equity rise and the accompanying Fed rate goosing aimed at signaling economic strength was less than after the Bullard bounce, not to mention the blatant oil goosing, which failed immediately after the Fed spoke. Just a month later, equities were falling anew, with both oil and interest rates at new multi-year lows. So the Fed, PPT, all orchestrated a similar goosing operation around the January 7th publication of the meaningless minutes of the December 17th meeting. And here we are today, just 2 weeks later, and the 10-year yield hit a new low for the move of 1.77% Tuesday afternoon, and the 30-year yield a record low of 2.35% yesterday. Oil has been mired in the $45 to $50 per barrel range for weeks, not looking too transitory, and the global economic outlook, including here in the States, is looking worse with each passing day. And thus, the Fed has again attempted to goose rates, oil, and equities, whilst of course suppressing gold and silver. The problem, however, is that it's not working, and with just 5 trading days remaining, if they can't get the markets to cooperate with them, Janet Yellen will have a very difficult time lying about potential policy tightening. To that end, copper was goosed from $255 to $264 in a matter of minutes this morning. Oil jumped from $46 per barrel to nearly $48 per barrel this afternoon, and the 10-year yield miraculously jumped from 1.78 to 1.85, all for no reason other than the Fed trying to prep the markets for its meeting next week. Gold, for the 6th time in 2 days, was pushed down below 1,300. With the most egregious rate occurring when the ECB announcement was actually leaked. However, by day end, it was unchanged at $12.94, whilst silver had its first close above $18 per ounce in months. Oh well, let's see what tomorrow brings. Okay, it's Thursday morning, and wow is all I can say. Apparently, the ECB didn't think 1.162 was low enough for the euro, following its trial balloon leaking of a $50 billion per month QE program. Thus, in true no credibility fashion, Mario and company panicked, increasing it to a whopping $60 billion per month. Yes, 1.1 trillion euros of money printing over the next 20 months to buy sovereign bonds already at record low prices amidst the worst financial and economic environment in European history, at least since the Black Plague centuries ago. As I write, the euro is at a new 11-year low of 1.142, and sovereign yields have plunged further, in some cases deep into negative range, as even at negative yields, investors expect to profit from the inevitable capital appreciation afforded by QE to infinity. Oil was goosed to $49 per barrel early this morning, but is all the way back to $46.30 as I write, and copper has lost all of yesterday's gains as the CRB collapses accelerates. Moreover, the Fed at one point had goosed the 10-year yield to 1.96% from 1.85% yesterday and 1.7% Tuesday, but following the ECB announcement has plunged all the way back to 1.86%. In my mind, validating strongly my statement last week that it would never again see a 2 handle. Never, that is, until hyperinflation inevitably arrives. Stocks were up, down, now up again, as clearly the PPT will never let them decline in nominal terms. At least, not until full-blown panic arrives. However, in real terms, well, that will be an entirely different story in the coming years, especially relative to gold and silver. And as for gold, it was stopped 3 more times this morning at $1,300 per ounce, but as I write, has moved up to $1,305, setting up this week's blatant line in the sand to quickly move from resistance to support, just like 2.0% on the 10-year yield has gone from support to resistance. Silver is up to $18.40 per ounce, and as for gold and other currencies, the explosive bull market is going into hyperdrive. Yen price gold is barely 0.5% from its all-time high. Australian and Canadian gold less than 11%. Rupee gold just 17%, and Euro gold too just 17%, as it is up more than 2% this morning. Think about how much money those 5 markets alone represent. As the more prices rise, the more people will fear inflation and want to buy more. Earlier this week, I wrote in urgent cry to Europeans to buy gold and silver now to protect themselves from what's coming from the ECB. And this morning's announcement proves that in spades. Of course, I could just as easily issue the same urgent cry to Japanese, Canadians, Indonesians, Argentines and Russians, and countless others, including, of course, Americans. And if, as I surprised, the Chinese do in fact depeg the yuan, causing it to plunge against the dollar, God himself won't be able to stop the tsunami of Chinese gold and silver buying. And given that China started 2015 by importing an incredible 61 tons of gold in the first week, and that's just through the channels that we know about, or 50% above 2014's record pace, how long do you think it will be before debilitating, potentially permanent supply shortages emerge? And heck, silver is the metal in truly short supply. So just think what kind of physical short squeeze we'll see there. Putting the icing on the cake, on this day and week of central bank infamy, Obama gave his State of the Union speech Tuesday night, in true hubristic fashion, titled, "The Shadow of Crisis Has Passed." This title is as uneloquent as it is ambiguous. But more importantly, are his speechwriters crazy? We have just commenced an historic commodity, currency, and crude oil collapse. Just finished our worst holiday spending season since 2008. While its economic data is plunging, the real unemployment rate at multi-decade lows, or highs I should say, and the entire world is in a rapidly expanding state of political, economic, and social crisis. And yet, the shadow of crisis has passed? I mean, though General Custer took the cake for famous last words, but from a Miles Franklin blog standpoint, this one not only takes the cake, but the entire bakery. Oh well, I guess we'll just have to watch and wait to see. But frankly, anyone betting on such idiocy deserves to be bankrupt, committed, or both. Conversely, the crisis has just started, and thus the time to protect yourself has